I'm curious what the case is for long duration in the face of some of the debt pressures that you're seeing on both sides of the Atlantic when it comes to public finances. What do you do with that? How do you trade that?
Well, currently we have a preference when it comes to the government bond market. We have a preference for European government bonds and UK government bonds over US Treasuries more broadly, given market pricing. But in terms of where we prefer along the shape of the curve, we like front end and the belly of the curve rather than the long end of the curve, precisely because of what you talked about, that we see the fiscal trajectory, high level of indebtedness, actually making the current level of term premium, which is still very, very muted, not sustainable, especially over a longer term. Now, having said that, income has returned, and we do find income in fixed income a more attractive source of kind of quality income in portfolios. But where we get that income matters in the context of the fiscal dynamics and the issuance dynamics that is coming up, that has been driving the relative performance as well.
But Wei, isn't that quite contrarian relative to the fact that in an election year, specifically in the States, with tariff risk, with even two wars raging in this region alone, isn't there a risk of capital flows going straight into American assets by the end of the year? Wouldn't that undermine the case for European debt?
I think if you look at actually the fiscal trajectory between Europe and US, there has been a bit of a decoupling. Yes, France has been recently downgraded, but more broadly, a European kind of direction of travel is a little bit more prudent compared with kind of the US direction of travel, almost regardless of who gets into the White House. We're more talking about where the money gets spent rather than if the money gets spent. So that's one consideration that is very important as we think about kind of the election landscape for the rest of the year. The other thing I would say is that, yes, capital can be drawn to US capital markets in the context of search for safer assets in the context of broadly unstable geopolitical environment. But U.S. equity market has been a almost more appealing place to draw such capital inflows so far, but also as we look ahead, right? So like you look at U.S. equity market, it's not just the AI theme. We're talking about 7 out of the 11 sectors actually growing their margins. We see this theme spilling over and broadening out, benefiting sectors that are a bit further downstream in terms of the AI play. And we do think that there are more ways to play it at this juncture.